Hi, I'm Russ Faulkner, and welcome to our module on Residential Mortgage Overview. I'm going to be your guide today. So at the end of this module, you should be able to explain why people use mortgages today, identify key mortgage types, differentiate a mortgage from a traditional personal loan, articulate the basic characteristics of all U.S. residential mortgages, detail the various major types of mortgages, and discuss the impact of changes in mortgage terms. So let's start by understanding what a mortgage is. So a residential mortgage is a loan secured by real property. So it has a real property attached to it that becomes the collateral or the secured part of the loan. A mortgage note accompanies the mortgage and provides evidence of the existence of the loan and the encumbrance of that real property. So it's the link, the mortgage note is the link to that real property. Home buyers or builders obtain a mortgage either to purchase, improve, or withdraw capital against the value of the property. Mortgages are also available from financial institutions and lenders, such as a credit union or a bank, either directly or indirectly through intermediaries. And many borrowers seek mortgages because either they do not have enough savings or liquidity, or they want to leverage their investment returns. So this is a little bit about the basics of understanding mortgages. So let's take a look now at some of the common terms in the mortgage industry. So first we're going to look at the common terms and the parties involved. So these are all of the people that are involved in the mortgage process. So the first person is the borrower, the owner, or the mortgagor. This is the individual or entities, or a company in some cases, that will own the property. So this is the person that's actually purchasing the property, is either considered the borrower, the owner, or the mortgagor, depending upon what phase in the cycle are and kind of what you're referring to them and why you're referring to them. So we have the landlord or the lessor as the person, the owner that rents or leases the property to a tenant or a leasee. We have the lender or the mortgagee, and this is the party funding the mortgage loan. So in most instances, this is a financial services organization or a bank or a credit union that's actually loaning the money to the borrower to purchase that home. We also have the property, and this is the physical land and or the building that the owner will control. Some properties are located on land leases, so the property right might not be there, so it might exclude the land itself as part of the asset. That's not really common in a lot of areas, but for the most part, when you're purchasing the property, you're purchasing the building and the land for the most part in residential mortgages. The guarantor is the individual or entity that promises to pay back the loan. It's virtually always the owner, but also often third parties with greater credit worthiness than the owner. So for instance, if a person says to their buddy, hey, can you guarantee this loan for me, which I wouldn't recommend, but it happens, their buddy turns into the guarantor, but the owner is actually the person living there. So then you have the leasee, rentor, or tenant, and they're the occupant who uses the property and pay the owner rent or lease fees. Another party that's involved is the credit rating or agency, and they give you a FICO score or a Fair Isaac score, and we're going to talk more and more about that in a lot of detail in a future module. And this is really to used as an assessment of credit worthiness of individuals and corporations based on the history of borrowing and repayments, as well as the availability of assets and extent of liabilities. So those are really the key people and key terms for parties within the mortgage process. So some additional common terms are property price. This is the purchase and sale amount between the owner and the seller. So if a property is being sold for $200,000, this would be the property price. Then you have the appraised value of the property. And this is the value of the property established by market conditions, including comparable properties and appraisals. So for instance, if you purchase a property for $200,000 and it comes back with an appraisal of $190,000, then the appraised value would be $190,000. And there's some implications of that which we're going to talk about a lot in future modules. So then you have your principal or mortgage amount. So this is the loan amount. So this is the property price minus the down payment. So for instance, in our continuing example of $200,000, if you have a property price of $200,000 and you put $20,000 down, you're going to have a loan amount of $180,000. So your down payment is the initial one-time payment paid towards the purchase of the property. So in our example there, it was $20,000. So it's the initial payment that's paid. Then you have a term called equity. And equity is the amount of ownership that has been built up by the holder of the mortgage. So equity equals the current property market value less the mortgage balance. So continuing our example here, if you have a purchase price of $200,000 and you have an appraised value of $190,000, you put $20,000 down, so that makes your loan amount $180,000. The difference between what you owe and the appraised value is $10,000, and that would be the equity that you have in your home. Another common term is term, and term is the length of the mortgage in years and months. So this is how long you're going to be paying on your mortgage. Typically it's 30 years, but we've seen shorter and we've seen longer, and we're going to talk about that in a lot of detail here in a few minutes. The next thing that's a common term is mortgage type, and this establishes the borrower requirements and mortgage conditions, including floating versus fixed rate. It's basically all of the details of the mortgage that you're getting is tied up in mortgage type. One of those details is the interest rate. So the interest rate is the cost of the loan in percentage terms. You also have a payment frequency, and that's how often you're going to pay. So if you pay once a month, which is very common, that will help you calculate the payment that you have, which is our next term. It's payment amount, and it's the amount of interest and principal paid based on the principal, term, interest rate, and payment frequency. We're going to talk about that in a lot of detail here in a little bit. And the next common term is fees. So these are any additional things that are paid up front to help you secure that mortgage from the lender or the person that you're getting the mortgage from. So continuing on our discussion of common terms, we have some ones here that are legal and other. These are terms that are very common and you should know. The first is terms and conditions. So these are any legal agreements to the mortgage document, legal agreements inside the mortgage documents that establish the rules of the road between the borrower and the lender, as well as their dealings with third parties. So it's important when a person gets a mortgage that they read these terms and conditions, because they're a critical piece of the document that they're signing. So covenants are promises made by the borrower, lender, guarantor, and others to engage in or refrain from specific actions. And there will more than likely be a few of those involved in your mortgage as well. Default is the failure by the borrower to abide by the mortgage terms and conditions, most commonly in regarding to payment. So that means that they're missing payments, or they're not paying on time, or they're behind in their payments, thus they're in default. A common term that goes with that is cure or fix. So a cure refers to the right of the parties in order to correct a default. So basically, that's the way that they're going to fix or correct that default or that behind in payments. You also have taxes and insurance, and this is money due to the government and insurance entities related to the property. Typically local property taxes, maybe state state taxes, maybe a county tax. You have different types of insurance that are required as part of your mortgage. And so it's important to really have an idea of taxes and insurance when you're starting to look at your payments for your program. Another term is prepayment and transferability. So this is the right of or restriction to the borrower to pay the mortgage principal before it's due, or to sell the obligation to pay the mortgage to another party. So for instance, the prepayment allows the borrower to pay the principal down before it's due. And they might have the right to do that, or they might have restrictions on doing that. And then transferability primarily deals with the lending or financial institution and their ability to sell your mortgage to another party for servicing. So there's also many other terms and conditions and all kinds of clauses that exist within the mortgage documents. We're going to cover those in a lot of detail in future modules, but we wanted to give you a high level of some of the most common terms associated with mortgages. So why do people use mortgages? Most people don't have adequate savings or liquid funds to pay for the property without a loan. So for instance, in our example of a person who's going to buy a home for $200,000, most people don't have $200,000 laying around in order to buy a property. So they use a mortgage to help with that purchase. In addition, the government encourages borrowing by allowing interest payments to be tax deductible. So any interest that's paid on your mortgage can be written off on your taxes. So in essence, mortgage interest is tax deductible, so you're going to save a lot of money versus a rent. So that's another big benefit of why people use mortgages today. Borrowers also gain the advantage of leverage, which we talked about as the use of debt to gain new assets, generating potential higher returns on capital. Now, if you look at the chart there, so let's say a person purchases a home for $200,000 and puts $40,000 down, and then the home value increases by 10%. They've made 50% on their money, and there's not a lot of investments out there that will pay you 50% on an annualized basis on your return on equity. So a lot of borrowers use a home as a way to generate potentially higher earnings on capital. So you can also tap into the value of real property as the value of the property increases through a home equity loan. So as the home property increases, you're not only gaining return on equity, but you're also gaining equity in the property that you can then pull out and use for other things through a home equity loan. So that's why people tend to use mortgages today. So we talked a lot about the differences between a mortgage and a personal loan. The main big difference is a mortgage is a method of using a loan product to buy a real property. So a loan is a type of debt, where a mortgage is a method of using property, real or personal, as security for the payment or the debt. So they use the actual property as collateral for the loan itself. Now, from a legal perspective, a loan is a delivery of a sum of money to another under a contract to return at some future time an equivalent amount with or without an additional sum agreed upon for its use or interest. And if such be the intent of the parties, the transaction will be deemed a loan. Now, from a mortgage perspective, it's a legal document which the owner or buyer transfers to the lender an interest in the real estate to secure the repayments of the debt evidenced by a mortgage note. So all that is the property is used as security to help with the repayment of the loan. So the loan itself, we look at a use of a loan. The borrower initially receives an amount of credit from a lender which they pay back, usually but not always, in regular installments to the lender. And a mortgage is seen as the standard method by which individuals and businesses can purchase residential and commercial real estate without the need to pay full value immediately. So they're not having to pay the $200,000 up front. They can pay $40,000 as a down payment and borrow or get a mortgage for the remaining $160,000, to continue our examples from before. Now, loans, there are several types. There's secured loans, which are secured by some type of property or collateral, and unsecured loans. On a mortgage, there are three main types, two of which are very uncommon in the U.S., but we're going to talk about them anyway. The first is mortgage by demise, the second is mortgage by legal charge, and the third is equitable mortgage. So like I said, these are three main types of mortgage. The two, the one on top and the one on bottom, are not very common in the U.S., and the main mortgage type is in the center in the green box, and that's mortgage by legal charge. And that's really where the debtor or borrower remains the legal owner of the property. Whereas mortgage by demise, the mortgagee or the lender becomes the owner of the mortgage property until the loan is repaid in full. And an equitable mortgage, the lender is secured by taking possession of all of the title documents of the property. So basically, the main difference is the first one and the third one, the lender takes control of the property or becomes the owner of the property until the loan is repaid in full. And those aren't very common in the U.S. The most common type in the U.S., again, is the mortgage by legal charge, the center one in the green box. And the main purpose here is that the borrower remains the legal owner of the property, but the creditor or the lender gains sufficient rights over it to enable them to enforce their security, such as the right to take possession of the property or sell it if the borrower defaults or is foreclosed on. So to protect the lender, a legal charge is usually recorded in a public register. So mortgage by legal charge is the most common type of mortgage in the United States. So let's look at some of the basics of a mortgage. And mortgage loans are structured as long-term loans customized to the needs and financial abilities of the borrowers. But they all have common elements. The first is the amount to borrow. And this is an amount that's set on the value of the property, anticipated use of funds, borrower's financial means, creditworthiness, amount of down payment available, property location, etc. The amount to borrow is also called the principal amount, and this is the initial amount that the borrower is going to borrow. So for our example before, if I'm going to go buy a $200,000 house and put $40,000 down or 20% down, my amount to borrow will be $160,000. Another common element is the mortgage type. So there's a whole wide variety of different types of mortgages, which we're going to discuss here in a minute. And the main differences are whether or not the loan amortizes, it has a fixed or adjustable rate, it's government guaranteed or not. So those are some of the common elements when we start looking at mortgage type. The next common element is the term or the tenor. This is the loan length or time to maturity, and it tends to be 30 years in the U.S., but can be much less or much greater depending upon the need of the borrower and the creditworthiness of the borrower. The next common element is interest rate and fees. So the level of interest and amount of fees determine the cost of the loan to the borrower and the return to the lender. This is set largely based on the anticipated risk of the borrower. So the higher the risk of the borrower, the higher the interest rate and fees. The lower the risk of the borrower, the lower the interest rate fees. So these are the four main elements that are important in every loan: the amount to borrow, the type of mortgage that you're getting, the term or the tenor, and the interest rates and fees. In addition, all mortgages have terms and conditions. These are things like right to repayment, security interest, and numerous other terms and conditions that control the mortgage loan, notes, security documents, and associated other instruments. So these are the fine print for the mortgage, and all mortgages are going to have some level of this that help with the rights to repayments and the guarantors and those types of things. And we'll talk about that in a few minutes. So the first main element that we talked about was the amount borrowed. Now, mortgage underwriting standards determine the amount borrowed based on a whole wide variety of things. So for instance, we look first at the borrower, and we look at income, we look at debt, we look at credit history, we look at savings, we look at guarantee, we look at use of funds, we look at a ratio analysis to look at debt to income and loan to value, and a whole variety of things from a borrower perspective. Then we look at the property, and we look at the location, the type, the quality, the loan to value ratio, the marketability of that property, and really kind of make sure that that property is worth what the amount that we're trying to borrow. So then we look at the lender, and the lender then looks at how much capital they have available, what is their investment strategy, what's their risk versus return needs, and then use that to measure the overall portfolio. So the lender needs to determine, hey, do I have money that I can lend out, and does this borrower meet my risk return needs? And then looking at the market conditions. So the state of the property markets, state of the capital markets. So making sure to really understand how is the market overall performing, and how is the property market in that geography performing. Both of those are very important when you're looking at investing in that property. So based on a good credit rating, the typical home buyer borrows 80% of the purchase price. So typically the mortgage cost, principal, and interest should represent less than 35% of the buyer's take-home pay. And that is really one of the things that we look at when we start digging into the borrower and digging into the loan-to-value ratio of the property itself. So that's a key indicator on amount borrowed. So now let's take a look at different mortgage types. Now, mortgage types are very complicated, and there are lots of different mortgage types out there. But I want to give you an idea of some of the wide variety of mortgage types that are available. The first that we're going to look at is a fixed rate mortgage. Now, interest is fixed for an amount of time. So it can be a 10, 15, 20, 30, even 40 or 50-year loan, at which point the amortized principal is paid in full. So for our example, if we get a 30-year loan, it's going to have a fixed rate of whatever that interest rate is that you agree upon with the financial institution. Now, a little different than that, we have adjustable rate mortgage. Now, this is a type of mortgage where the interest rate fluctuates with the indexes, such as the prime or LIBOR, and plus a set margin, so it might be prime plus X%. And the adjustment intervals are predetermined. So it might be adjust monthly, it adjusts yearly, it adjusts quarterly, depending upon what that financial institution and borrower agree to. So minimum and maximum rate caps limit the size of the adjustment. Now, the main difference between these two types of mortgage is that if you have a fixed rate mortgage, your payment is going to stay the same for the entire term. So for that 30-year term, your payment is going to be exactly the same every month. Whereas the adjustable rate mortgage, your payment is going to fluctuate as the market fluctuates. So your payment could go up or it could go down. But it's important to realize that an adjustable rate mortgage might have a lower introductory rate or a lower interest rate in the beginning, but if you start looking at the amount of money you pay over time, it could be a much riskier type of loan. Another mortgage type is a balloon mortgage, and this is a fixed rate for a period of time, but the principal is not completely amortized, so it's not paid down during the period. And at the end of that term, the entire balance of the principal is due as a balloon payment at the end of that period. Balloon mortgages were very common back in the 30s, 40s, 50s, but they're not as common today because home prices are increasing and not a lot of people have that type of capital put aside to pay those balloon payments. But they are still available. Another common type is a jumbo loan, and during this program we're going to talk a lot about government sponsored entities such as Freddie Mac and Fannie Mae. They have a lot of conforming guidelines. And one of their guidelines is a loan can't be over a certain dollar amount. The most current dollar amount is $417,000. But we know that there are mortgages that are needed that are above that, and those are considered jumbo loans, and other lenders will secure those loans. We also have a second mortgage or a home equity loan. A home equity loan is when a lender gives you a lump sum of money and you pay it back over a fixed payment schedule, just like your primary mortgage. These are for a second mortgage to really pull equity out of your house, either to improve your home or to purchase other things. And very similar to a home equity loan is a home equity line of credit. And the main difference here is that instead of giving you a lump sum that you pay back over a fixed payment schedule, they give you an open line of credit, and you use that line of credit until your credit limit is reached. So if you have a credit line of $30,000 and you only pay $1,000 to maybe update the fixtures in your house, then you're only going to be paying on that $1,000, and you still have a $30,000 or $29,000 open line. So home equity line of credit or HELOC are very popular today and tend to have an adjustable rate, much like a credit card, versus a home equity loan, which is going to be a fixed rate for the majority of time. So the 6 loan types that we talked about on the previous slide are the most common loans. These are some other types of mortgages that we wanted to talk about but are not as common as the ones on the previous page. So we have an interest-only ARM, and so this loan type is for a period of time you pay only interest and do not pay down the principal. This was very common in the mid-2000s, and a lot of borrowers would purchase an interest-only loan. And the reason that they would do that is because if you're not paying down your principal, your payments are going to be much less than if you had a principal plus interest loan, which is a more traditional loan type. Another loan type is the 1-year Treasury ARM, and this is a fixed rate for 1 year and then becomes adjustable every year. The new rate is determined by the Treasury Index plus a loan margin, usually 2.25% to 2.5% for a 30-year term. Now, and anytime we have an ARM loan, that means that it's going to be fixed for a period and then it's going to be adjustable after that. So much like we talked about on the previous page when we were looking at an adjustable rate mortgage, these adjustable rate mortgages can be very lucrative. They could have low cost up front, but as time progresses, the payment that you pay could be much higher because it continues to increase the interest rate. So we also have an intermediate ARM. So with an intermediate or hybrid ARM, the rate is fixed for a period of time, then adjust on a predetermined schedule. So this is shown by the number of years the loan is fixed and the adjustment interval. So a 3-1 ARM is a 3-year fixed and a 1 adjustable annually. So that means it can adjust 1 time annually. So the new rate is determined by an economic index, usually Treasury, LIBOR, prime rate, plus a loan margin, usually 2.25% to 2.5%. And it's typically a 30-year term. So that's kind of the difference between these different types of adjustable rate mortgages. So we also have a balloon conforming mortgage. Now an interest rate is fixed for a period of time, but the principal is not completely amortized. For the remainder of the term, it adjusts to a new fixed rate determined by Fannie Mae net yield index plus margin for 30-year terms. So basically this is a balloon mortgage that is done by Fannie Mae and Freddie. So it's a little bit different, but it is still a balloon mortgage. Then we look at the flexible payment option arm. And so this is the borrower chooses from an assortment of payment methods every month. There is a change cap limiting how much payments can vary in a year. So this gives the borrower a lot of flexibility, but it might not pay down the loan as quickly as need be. And it can vary greatly because it is a ARM loan and it is an adjustable rate loan. And then we have a convertible ARM. It is an ARM that can be converted to a fixed rate after a period of time. So this is a loan that might have a adjustable rate for the first few years, and then after that it has the option to switch to a fixed rate over that period of time. So that could be a good option for a lot of people. Now in addition, we have a few additional loan types that are important to understand. The first of which is a veteran administration loans. Now veteran administration loans are a zero down payment loan offered to veterans only, and the VA guarantees the loan for the lenders. So this is a fantastic product for our veterans. Next we have the Federal Housing Administration, or FHA loans. So these are government insured loans with little down payment, as little as 1 to 3%, and closing fees included. The government insures these loans. The next is the reverse mortgage. And this is a loan that's primarily sold to elderly homeowners who need to borrow against the equity of a home while still living in it. The debt does not need to be repaid until the house changes hand, and interest is commonly 1-year treasury rate plus a margin and a cap on a rate exchange. So this is a loan for our elderly people that want to take value out of their home and pull value out of their home to help in their retirement. And the last type that we're looking at here on this page is assumable mortgage. This is an adjustable rate loan that the balance of which can be assumed by the home buyer. So this is another interesting loan type, and these 4 on this page are very important for us to understand as we continue to delve into mortgage types. So when we're looking at a lot of different mortgage types, what we need to notice are mortgage types are designed to accommodate customer requirements. The more variety means the more complexity and potentially greater risk for not only the lending institution but also the consumer, because the consumer needs to understand them as well as the banks and lending institutions. Another thing to look at is adjustable and floating rate loans involve great risk, higher uncertainty for the borrower. Increased rates can increase their loan payments tremendously in a very short amount of time. So what seems like a really low payment when you initially get the loan, if it adjusts up, it can greatly increase the overall payment that you have. And so with the greater variety comes the obligation for underwriters and servicers to exert greater scrutiny to maintain quality. So all of these different loan types increase the overall complexity and potentially greater risk for both the bank and the borrower. So another key element of the mortgage process is mortgage terms or tenor. So the typical U.S. residential mortgage is 30 years, but numerous programs exist, including 15, 20, 25, 30, and we're even now seeing 40 years available to some borrowers. Now the reason that that's important is as the term or tenor increases, so the more years you have, the lower your payment's going to be. So some borrowers opt for longer terms to decrease their payments. So the term or tenor of a mortgage should match the purpose and financial means of the borrower, specifically expecting the holding period. So how long do you expect to own the property? So the expected holding period is how many years the borrower expects to own the property. Because the longer-term loans virtually always involve lower payments, many borrowers will opt for longer-term loans simply to lower their regular payments, whether or not they expect to hold the property that long. So let's look at the impact of term or tenor on equity value. So on our example on the left-hand side, we have a 30-year mortgage and a 15-year mortgage. So for our example here, the value of the property is $200,000. They put $40,000 or 20% down, and they owe $160,000. Now, if we have an interest rate of 5%, for a 15 or 30-year term. So for a 15-year term, your payment is going to be $1,265, whereas a 30-year term, your payment's going to be $858. So really there's a $400 difference between just changing the term from 30 years to 50 years. But let's fast forward a couple years and see what happens to the equity value that you build up in your home based on that extra $400 a month and the shortened term. So if we look at after 10 years on a 15-year mortgage, you're going to have an equity of $132,000 in your home, or 66%. Whereas on a 30-year term, you're only going to have, after 10 years, just shy of $70,000, or 35% equity. So you see how the shorter the term and the greater the payment, the much quicker equity increases in your home. So that's why it's important to look at the term and get the shortest term that you can afford to build that equity quickly over time. So what to notice? So these mortgage types are designed to accommodate the customer requirements. Shorter term mortgages result in more equity buildup faster. So many residential home buyers acquire properties that are more expensive than they can afford and do so by extending the term of the mortgage. So more variety, again, means more complexity and potential risk for not only the borrower but the lending institution. So mortgage interest and fees, the perceived risk in return determines the level of mortgage interest and the fees charged by the lender. The higher the risk, the higher the interest rate, and the higher the fees. The rate of interest and amount of fees charged can greatly impact the return on investment for a borrower, and we're going to delve into that here in just a second. So let's look at our same example, $200,000, the amount borrowed $160,000, so they put $40,000 down. They have a 5% interest rate for a 30-year term. Now let's say that that interest rate fluctuates. So on the chart on the right, so we have a 5% interest rate. Interest paid over the life of the mortgage is going to be $149,000. So over the 30-year term of the mortgage, you're going to pay $149,000. Now, if that interest rate was reduced to 4%, you're going to save $34,000 over the life of the loan. But if that interest rate is increased to 6%, you're going to pay an additional $36,000 over the life of the loan. So you see how interest rates, just minor decreases or increases in interest rate, can have a drastic impact on the change in the cost that you have on your overall mortgage. Now, another key area that we want to look at is terms and conditions and claim priority. Now, for the most part, most people will have a first mortgage, and that first mortgage will be the most senior lien position on that home. If you have a home equity line of credit or a second mortgage or any additional mortgage products, those will be in a junior lien position. So that's a second mortgage or a third mortgage or home equity line or whatnot would be in a junior lien position. Now, lien priority is established by the date of recording in the locality. So it is super important that all liens must be recorded in order for them to have any level of seniority as they're starting to look through the priority of those liens. So seniority establishes claim to a real property asset. So seniority establishes claim to your personal guarantee. So failure to record a lien is a significant cause of loss in foreclosure. This is not a common problem for lenders. Most lenders are pretty good at recording liens very quickly. So making sure that you have your lien recorded is critical. Now, lien priority or claim priority, there are a few exceptions. So property tax lien has seniority over everything, and it doesn't matter when that was filed. Sometimes mechanic liens have seniority, and explicit subordination clauses will take priority, and bankruptcy proceedings may modify debt holder rights. So if you go through a bankruptcy proceeding, the judge might say how the debt holder rights are to be established, and that might throw out any senior and junior lien positions. So that's a little bit about claim priority when we start looking at senior and junior liens within the lien priority establishment. So an example of how that might work, so let's say a person has a first mortgage of $90,000 and a second mortgage of $20,000 and a third mortgage of $10,000. So in a foreclosure, the property, let's say, sells for $100,000. So the first mortgage receiver receives $90,000, the second mortgage holder receives $10,000, and the third mortgage holder receives nada. So it's important to understand from a risk management perspective how your company's mortgage position is determined and how your company's mortgage position is held for a lot of the loans that you have and a lot of the loans that you're servicing. So this has been the residential mortgage overview section. Thank you for joining us today.